There's a difference between having a late payment and when that late payment is reported. This is really important to think of. And so typically companies you're borrowing from report your credit to the credit bureaus every 30 days. And they generally don't report late payments until they're 30 days late. So if you're 5 days late on a payment, you may get a late fee on that payment from the company you're borrowing money from, but that doesn't get reported until that 30-day period is up. And so,
good to know.
So this is a credit rule number one is always find out when your credit is getting reported from the place that you're borrowing that money from. Welcome back to another episode of the Isn't That Rich podcast. I'm your host, Jill Franks.
And I'm your other host, Ashley McVicker. And today we are talking about credit, how to play the game and win.
So we've mentioned credit in a few of our previous episodes, but today we're giving you the entire playbook on how to play the game of credit.
Yeah.
Because that's what it is. It's a game we all have to play.
It really is. And it's like you don't know it until you start growing up and wanting to buy things and you're like, I have to learn about this.
And that's when it gets to the point where it's way too confusing and you just need somebody to explain it to you. So here we are doing just that. So what exactly is credit, Ashley?
So credit, Jill, in its most basic terms, is a 3-digit number that helps lenders judge the likelihood that they'll be paid back when they lend money. Our credit score determines our credit worthiness, and it's not really something you can opt out of. If you ever want to borrow money to buy a house, to get approved on an apartment application, and even get a job in some cases.
Yeah, because all of those things run your credit report or
all of them
run a background check on you, and they look for that.
Yeah, because it's determining if you can pay something back.
Right.
Seeing if you're trustworthy.
Right. So the basic concept of a credit score makes sense if you think about it. Lenders need to be able to trust the people that they're lending money to. And that's not their money that they're lending out, it's the public's money. So they want to make extra sure that they're lending it to people who will pay it back. Mm-hmm. And the story about how the credit, so there hasn't always been credit, right?
Yeah,
or it's not been a thing forever.
It's not something God made.
No. And so like in the 1950s, there's these two men. It was Bill Fair and Earl Isaac. And they came up with this systematic way to give each individual person a score. And it's kind of how they gauge your credit risk. So they're going to say, Ashley is this amount of risk for a bank or a lender. And it's different for every single person. And I mean, I'm sure most of our listeners have heard of a FICO credit score. Mm-hmm. Well, this is the Fair, Bill Fair and Earl Isaac. So Fair Isaac. Yeah. And then it's a company, CO, FICO.
Okay. So that's
Fair.
what I check on my Discover card every month is my FICO score. And
exactly.
I always wondered what that stood for. So it's those people.
And the way this grading system, the system that they created works is that it's kind of compared to a student in college, right? So you go to school, you get these grades and you get a report card or that is your transcript. And at the end of there's different elements for your grade and each one of those elements of your grade is weighted differently. So if you go, if say you're taking a history class and your final exam is weighted 50% of your score.
Total grade,
Yeah. And so a credit score kind of works the same way. So it's going to look at different behaviors of your credit and how you apply them to your credit and add all of those up, and some are weighted differently. So we're going to talk about that later on.
Wow.
Yeah.
So one thing that I really want to point out about credit is that it doesn't really take into consideration the whole story of a person. So just like school, not everything is going to come into consideration, like your personality or how nice you are or how well you dress. It's really just a matter of like you either missed a payment or you did pay something on time. You know, it's pretty black and white, wouldn't you say?
Yeah, for sure. Like you said, it doesn't take, like, I think about, you know, if you're sick and you miss a payment or you just, you know, you miss a payment for something, a missed payment is a missed payment is a missed payment.
Right. And like in school, if you're sick, like you can
get excused.
Or have a little bit of a later time to do it. And no, if you miss a payment on something, or
it's black and white. It gets reported, and that gives negative feedback to the credit bureaus.
Yeah, and that's how you get your credit score lowered.
Yeah, and the hard thing is about a missed payment is that it can lower the credit score and stay on your credit history for a really long time, up to 7 years.
Wow.
So just one missed payment can stay on that report, which is a really long time.
Yeah, so that's definitely, you want to make sure whenever you are borrowing money that it is something that you can pay back.
Yeah.
And that you can be responsible for. Because like you said, 7 years is a long time for something like that to be on your credit report. And so now that we're talking about credit report, Jill, why don't we talk about the difference between a credit report and a credit score?
So your credit score is that 3-digit grade based on a calculation that measures your credit worthiness based on that credit report. Or if you think of it like that analogy of the student again, that's your GPA average. So think of your credit score as your GPA and your credit report as your report card or transcript. And that is the closest analogy I can give you.
And so I feel like I can make it even more specific. It's like if I took a science class, like that would be on my transcript. And so if I borrowed money to pay for a Corvette, that's on my transcript, my credit report.
Yeah.
So you can see all the times you borrowed money or quote unquote took a class, like Jill's giving the analogy about a transcript. That's really great.
Yeah. And we mentioned those elements, and I want to go through those elements now, because what makes up your credit score, a lot of people don't take into consideration.
Yeah. So right here you have payment history makes up 35% of that score.
35%. It's a huge weight, right? So that would be like that big final test.
Yeah.
In school, that big
that
final
you're stressing
test.
Out over.
Yeah.
So your payment history is huge. Your payment history is how you've handled paying back money that you've borrowed in the past. This is definitely the largest factor in calculating your credit score. Have you made any big payments over time? Since this is the largest factor, missing a payment can affect your score in a very big way. Even if it just happens one time, it also takes a long time for that missed payment to drop off. So as we mentioned earlier, 7 years.
Wow.
7 years for a big payment to drop off.
I know, it's so sad, but time heals all wounds, right? Like, so if this is the first time that you're taking into consideration your credit or even thinking about it, because a lot of people go through life and they don't even really look at it.
Or like, no, they have to have it.
Yes. And so if this is you and you're relating to this, don't worry, because as time passes, you can take steps to correct your credit.
Yeah, things can be fixed.
Absolutely. So we're going to talk about we're going to give you the playbook, like we mentioned earlier, on how to play the game of credit. And this is the first rule in that credit game. So here's the first rule, is that you should find out when your credit is getting reported. Now, there is a difference for your payment history. So there's a difference between having a late payment and when that late payment is reported. And this is really important to think of. And so typically companies you're borrowing from report your credit to the credit bureaus every 30 days. And they generally don't report late payments until they're 30 days late. So if you're 5 days late on a payment, you may get a late fee on that payment from the company you're borrowing money from, but that doesn't get reported until that 30-day period is up. And so,
good to know.
So this is a credit rule number one, is always find out when your credit is getting reported from the place that you're borrowing that money from. Another thing to know is if you miss your payment 2 months in a row, that will count 2 separate negative reports, right? So you missed that first one, you're 30 days late, they have already run that report, your credit got dinged. Well, just because it's a continuous non-payment doesn't mean that you only have one bad report. It will report for every
30 days.
List.
So it's a ding and another ding.
So that compounds, right? So that's going to make it worse and worse. So missing a payment twice in a row, you'll get hit twice for that.
And the thing is, if your credit score gets so bad and so low, like you are not going to be able to borrow money anymore.
Right.
So if you want to continue to borrow money, you want to make sure you're not doing stuff like this.
Right. Exactly. So, yeah, your credit payment history is the number one way to build your credit. On-time payments. Make sure you find out when that credit is being reported.
So the next element that makes up your credit score, that is 30% of it, is your credit utilization ratio. And so your credit utilization ratio is the amount of credit you are using out of the amount of credit available to you. So this is for all revolving lines of credit you have, not your mortgage or installment loans. For example, say you have a credit card with a limit of $10,000 and you're using $3,000. We can calculate the ratio by dividing the amount used, which is $3,000, by the total amount available, which is $10,000. Then multiply that by 100 to get a percentage, 30%. The lower the credit utilization, the better your credit score will be. If you're maxing out your cards regularly or have a high ratio, it might be an indication you're living beyond your means.
All right. And we talked about that before on an episode, but your credit utilization is so important that...
And no one teaches you about it, especially when you get a credit card. You're like...
Yeah.
I think the best way to say that is like, right, if I have a $10,000 limit maybe on my credit card, I probably should only be using $3,000 of it.
Yeah.
That 30%.
Or 30%, right? You said, you kind of said that. And here's another rule to the game. And we'll talk about that. So with your credit utilization, you should always keep your ratio below 30. You already said that. But a simple thing you can do, and one of our mortgage lenders
actually told us this the other day. I was like, good idea.
And she said one thing you could do right now to increase your credit score or your utilization ratio is to increase your limit on your credit card.
Yeah. And everyone kind of acts like that's a bad thing, which it can be if you are like super tempted to spend money, but.
Yeah. So why people think that's a bad thing is that there is going to be a hard pull. We talked about pulling credit in another episode as well, is there's going to be a hard pull when this happens. So if you're in the process of buying a home or you need a bigger loan, this isn't the time to be upping your credit card limit. No, do it only when you need to up that utilization level. Yeah.
And I think it's important to note here, like a hard pull is a hard pull is a hard pull. It doesn't matter if the credit card company is doing it, if the bank is doing it, if the auto financing place is doing it, like it all runs your credit the same way, wouldn't you say?
Correct. Yeah.
Yeah. That's a good one. So basically, if you can get more of a limit on your credit card and then you use less, you're going to be under that 30% threshold.
Exactly.
It's a great little way to play the game.
Little tip. Yeah. The next one is the length of credit history element to our credit score. And that is weighted 15% of our total score. So the longer you have a healthy credit history, the better. So if you take two people and one has had a 25-year history of credit, and they're using it healthily and they are using it responsibly, and then you have a 2-year, this person that's only had a credit history of 2 years, well, who is the bank going to trust more? Somebody who's established a well-established credit history with them. They know for 25 years they've made on-time payments. So yeah, that person is going to have a stronger credit score.
Yeah. So rule number 3 for the length of credit history is to not close out your longest line of credit.
I think this length of credit history is the toughest one because you really can't do anything about it.
No, I mean, it's just like what you said earlier. Like it's a time thing and you just have to wait it out. And even for me, like I have great credit, but on my credit card, I can see, what the yellow kind of ding is in it. And it's like, you don't have that long of a history. But I'm like, but I'm paying my stuff back.
I know. I look at mine every month too.
I'm doing so good. Come on.
And that's the only one I'm really, I notice that it's it's in the good standing instead of like the great or excellent, whatever it is. And it's like, well, you've only had 18 years of credit. I feel like 18 years is a really long time. No, but yeah, so that is it's the hardest one. You can't really do anything about it. But like Ashley said, a great tip is to never close a credit card account that you open, even if you're not using it.
Yeah. And I think about kind of some scary things that people, we all know that people say, cut your credit cards up, just snip them in half. And like, be careful with the scissors because that actually might damage your credit if you're not, or if you decide to close out all those accounts, because it can damage your credit, or it's not helping it, certainly, because if you leave a credit line open longer, we know that that helps your credit score, just like we talked about.
Yeah. So the only thing with keeping that open and you're not using is just be sure that you're keeping an eye on it. So watch out. We all know that there are credit fraudsters out there ready to pounce on those inactive accounts.
Yes. All right. So the next element that is weighted 15% for your credit score is getting new credit.
And this is weighted 15%. So when you apply for new credit, it will bring down your credit score temporarily. So if you're constantly out there making purchases, you're buying a motorcycle here, a car there, a mortgage there, it tells lenders that you might be strapped for cash. So you're using it, you're maxing out your credit card, whatever lines of credits that you have. It just tells that the lenders that you might be a risk of borrowing too much if you lend them anymore. So there is an exception to this. I know people go out there and they shop for a mortgage and they're going, maybe they go to 3 different mortgage offices and they want to apply for a mortgage and just compare the 3. Well, during this period, the credit bureaus can pretty much determine that that's what you're doing. And so they'll say, okay, this is happening. And the shorter amount of time that you do that, if you can do it all within 14 to 45 days, they'll recognize that and it will drop off. Like the negative impact will drop off your credit score really quickly. So that's a good tip for people who are shopping for mortgages. Don't worry about it only in that example.
But what if I went with a lender and they pulled my credit and then after 45 days they pulled my credit? Then that's different,
and
right?
And that is a different situation.
So you're saying if you are shopping for a home loan and you're serious about getting a mortgage, like make your schedule with these lenders.
Yeah. Do it in a 2 weeks period of time. Yeah. So take your 14 days, make those 3 visits to these lenders, apply all at the same time. So go to one bank, bank A, bank B, bank C, send in your applications. They'll pull at the same time. The bureaus will be able to figure out that you're making an investment or you're getting ready to make a big decision, and that will drop shortly.
Yeah, because it's like you need to know.
Absolutely.
Because you may not want to go with one certain bank.
Right.
But they really can't do much until you allow them to access your credit.
That's right. They have to get the whole picture of what's going on with your finances, and that's the only way for them to do it. So keep in mind, the next credit game rule is number 4. If you're applying for a mortgage, stick to 14-day to 45-day window when you're applying.
All right. So the last weighted element we have is type of credit used. So debt that has fixed payments over a fixed period of time for a fixed amount are considered better forms of debt than revolving credit like a credit card. So if there is a clear path to payment, lenders can see exactly when they will get their money and offer lower interest rates, which is obviously awesome. With a revolving credit, the path to repayment isn't as clear, and so they often have a higher interest rate on whatever percentage of credit you used. Some people carry these credit card debts for years or even decades.
Yeah. And that's scary too, right? So people get into credit card debt and it lasts for decades and years.
Especially if you don't clip it. It's like, it just keeps rolling because revolving credit can be.
Yeah. So let's just quickly recap those 5 elements again. So we have number 1, your payment history. Number 2 is credit utilization ratio. Number 3 is the length of credit history. 4 is new credit. And number 5 is which type of credit used. But now we take all of those things into consideration. We're going to try to figure out what a good score is. So after all of those things are weighted, you put it in the credit bureaus, compute your credit score. And now what do they consider a good credit score?
Yeah, you just get this number. Yeah. It's like crazy that all 5 of those things go into it, all this hard work, and it's just like, here's a number for you.
Here's a number.
And that's what they look at. So, Jill, what's a good credit score look like?
So credit scores range from the lowest at 300, all the way up to a perfect score of 850. And according to my credit card, which I love,
say it.
It's the Capital One Venture card that I have. And this is
not sponsored,
not affiliated. Anyway, it's what I actively use to monitor my credit score, though. And so I can log into my credit card account and I can see my CreditWise credit score, and they use the Credit Bureau TransUnion to pull their score, which is what a lot of banks in the Midwest also use to pull their credit score. So it's what our bank, Farmers State Bank, uses to determine somebody's credit score. So I feel like that's a safe bet. But within that, depending where your credit score lies within that 300 to 850 range, there are 4 different levels of a credit score. And so the first one is an excellent score. And that, if your credit score lies within a 761 to an 850 score, that is an excellent range. So you have excellent credit. You're going to get the lowest interest rate on a loan.
You're very trustworthy.
Yeah.
Clearly you pay stuff back.
And then the next level is good.
Good.
It's a good score. And that range is from 701 to 760.
So you're still in the green on the chart.
You're still in the green. And now the next one, the third one, is a average score, which is from 621 to 700. And a below average score is from 300 to 620. So after you hit that 620 threshold, that's when you know you need to do the most work to improve your credit score.
And that's crazy to me that like below average one has like a 320 point jump. Like all that number in that is like below average.
Yeah, I know.
There's the other ones jump by like 100 or less than 100.
50 almost.
Yeah.
Yeah. So what an average score and above is rewarded with that lower interest rate and better credit and debt options, which can add up to saving customers thousands of dollars over the time. We talked about how interest rate works a little bit in previous episodes, but the higher your credit score, the lower interest rate creditors will offer you.
Yeah, because they know they can do business with you and you're going to pay it back.
Yeah.
And so really essentially what this is saying is like if you have a below average credit score, like, oh, you're not, you may be trustworthy, but like your number tells us you're not, or you've done something.
There's something going on there. There's something that happened in the past.
So we have to protect ourselves as an institution and make sure we get paid.
Yeah.
Because we're a business.
Right. It's also like, if you think back to that classroom, like if you have a below a C, your professor is probably going to be having a conversation with you, and like you might be asking them for extra credit. Like, how can I do better in this grade?
Or like you can't move on to science 2 if you can't pass science 1.
Right.
Like if you can't pay back your motorcycle, you sure as heck can't pay back your home.
Right.
It's a great way.
So the last kind of rule to our playbook, for our credit game playbook, is that you should be reviewing this at the minimum of 3 times a year. So if you don't know what your credit score is, or you haven't looked at your credit report in the last 3 months, we used to say a year, but the more research I've been doing and the more fraud that is out there, I would encourage you to do it every 3 months.
And you can with annualcreditreport.com, which is the safe website to go to.
Yes.
And it pulls from all 3 credit bureaus. And that's a great way to check your credit report. Remember, so that's like your, what do you call it? Transcript. Yeah.
Yeah.
That is a great way to look and see if you have fraud on there. That's great to see everything. So go to annualcreditreport.com. You'll be able to see all of those from all 3 of the bureaus. Equifax,
TransUnion,
and what is it?
Isn't it Experian?
Experian. Yeah. I'm like sitting here with an E, like I know it.
I love it. Okay. So that's kind of a play-by-play with credit. I mean, it's short and simple. The 5 elements, get to know them and improve on those 5 elements. It'll rebuild your credit score and improve your credit history.
Yeah. And if you have any questions about credit or you need help with credit, you can always stop by Farmers State Bank. We have a lot of amazing employees that are there to help you with credit and help you get you where you need to go.
Yeah.
So you can buy the things you want to buy and do the things you want to do in life. And that's what we all want.
That's exactly right. So thank you for listening to this episode of the Isn't That Rich podcast. We'll be sure to include any links that we mentioned in this episode in our show notes. And we hope to see you again next time. Thank you.
So Jill, where do we go from here?
Be sure to check out our show notes for this episode, and also be sure to follow us on social media and subscribe to our newsletter. And we'll see you next week.
See you next week.